Okay, so here is your quick introduction to current and capital account to help you out with Mod 41, the beginning of Mod 41 in particular. First, an overview of this unit. When we study foreign exchange, we call the study of foreign exchange open economies. And so pretty much so far in this class, we've pretended that the rest of the world doesn't exist for most of our discussions of fiscal and monetary policy. But now we need to kind of begin to broaden those horizons, and we talk instead about what's called an open economy rather than a closed economy. And there's a few things we need to know. Now, the first thing we need to know is how and why nations trade. That is actually the one thing we've already done. We've already talked about comparative advantage, and we've talked about using a PPC to show why nations might be interested in trading with each other. But the two additional things we need to do is talk about how governments measure and record the trade that takes place between countries, and then talk about exchange rates and how exchange rates influence trade between nations. But this lesson is going to focus on this idea of measuring trade and measuring what's called the balance of payments. The best way to think of this is that we talked about measuring GDP, we talked about measuring unemployment, we talked about measuring inflation, and so net exports is this critical, or the trade balance is this critical feature of how an economy is operating, and so we need to talk about what's happening there, and that's called the balance of payments. So here are your three most basic understandings that you need to know in total, and then we'll go into each of them individually. Understanding number one is that the current account is an account used by the government to record payments for goods and services. In other words, the current account is virtually identical to net exports. It includes a little bit more than net exports, but the current account is overwhelmingly the trade of goods and services between countries. Thing number two is that the capital and the financial account record payments for assets between countries. And that word assets, and therefore that word liabilities, is also going to become really critical here. The capital and the financial account are technically two different things, but for the AP exam, they compile them into one total idea. And I believe they use the word capital most often. But for our purposes, we're going to bounce a little bit back and forth. We can call it either the capital account or the financial account along the way. The third and most important thing to understand is that these two accounts have to add up to zero. The current account and the capital account have to add up to zero. The other way to say that is that they must be inverses of each other. If the current account is positive, if our net exports are in surplus, then the capital account must be negative, must be in deficit, and vice versa. If the current account is negative, and in the United States, the current account net exports is almost always negative, that is offset by a positive on the capital account, right? So a negative current account leads to a positive capital account, and vice versa, because these two accounts have to add up to zero. So let's dig in more into each of these accounts individually. The current account is measuring, as we just said, it's measuring net exports as the single biggest idea. So it's measuring goods and services. There are two other basic functions or basic types of transactions that appear on the current account. Income is on the current account as well. What we mean by income, first of all, is we could mean wages. So if you have a job that is technically with another country or in another country, but you are working in the United States, then the money that you receive from that job is income, and that is on the current account. So if I were working for a company in France but living in the United States, then every 2 weeks when that company sends me my paycheck, that paycheck comes over. In a sense, it's a payment for a service, but that income comes over. But income could also be the income that I make off of an asset that I own. So the dividend that a stock pays is a form of income. Or if I own a property in another country and I rent it out, the income that comes back from that factor, that land factor or that physical capital, is on the current account. And the last item here are transfer payments. And transfer payments, remember, are payments that move without any form of expected good or service in return. So we're talking here about government aid. The United States, for example, sends money to countries all over the world, and that would show up as the United States just sending money to a country like South Africa to help with medical research. But you can also think of what are sometimes called remissions by U.S. residents. So immigrants who move to the United States and earn income in the United States and then send some of that money home to someone who lives in another country. That is a transfer payment. They're simply sending the money home. There's no expectation of repayment, and that is on the current account. The best way to summarize the current account is the idea that the good or the service is moved across borders, and the transaction is over as soon as the money is sent. There's no continuing relationship here. If I buy a hat from China, I send the money to China, they send me the hat, and that transaction is over. I no longer have an interaction with that company anymore. This is going to contrast with the assets and liabilities that are going to show up on the current account where the relationship continues. But in each of these locations, or in each of these transactions, even in the income transaction, I do work for another country, they send me money, that payment and that relationship are officially over at that point. Just as a real world example on this, this is the United States current account. I believe this is from 2018, and we can just break down. You can see all the way at the top are exports and goods and services, and they break it down into each. They include income receipts on U.S. owned assets, compensation of employees, all show up on the current account. And then we also have the imports, and notice that the imports are negative here. That's because the balance of payments accounts track where the money goes. It doesn't matter where the good goes, it matters where the money goes. So when the United States exports a good, the money comes into the United States, and that's a positive. When a U.S. employee is compensated from a foreign company, money comes in to the United States, and that is a positive here. Imports, we buy goods from foreign countries, and Americans then send money away, and those show up as negatives. Income payments that we send to employees in other countries show up here as negatives. Great. The capital and the financial account record costs and payments for assets, and specifically payments for assets that create future liabilities, right? So an asset is anything that brings you money in the future, and therefore somebody owes you money. That's the liability on the other side. So there are largely two different types of assets, of course, that we could talk about. There are physical assets. I could buy land. I could buy a copyright that exists or a patent that exists in another country. I could buy a physical property, a building in another country. Anytime someone buys a physical asset in another country, that is called foreign direct investment, and that's just a good word to have. So instead of an American company investing in America, when an American company like Ford or Coke or Microsoft invests in a foreign country, then they are doing that same level of investment spending, but they're doing that investment spending in another country, so foreign direct investment. But we also would have on the capital and financial account financial assets. When an American citizen buys stock in a foreign company, Sony is a Japanese company that is traded on the Japanese stock market, the Nikkei index, right? When an American buys a stock in a foreign company, they're buying a financial asset that is also a liability for a Japanese company, and that creates a balance of payment transaction. This could also refer to foreign bonds, whether they be government bonds or business bonds. The biggest thing to notice here is that in this case, the asset stays where it is. If I buy land in China, the land stays in China, but the ownership changes. The ownership is now American ownership of an asset in China. Same thing with a financial asset. When I buy a stock in Sony in Japan, the company of Sony is still headquartered in Japan, and it's still a Japanese company. But part of the company's ownership is now mine, and therefore that now belongs in the United States. So the assets stay where they are, but the ownership changes hands. We're looking for physical factories or physical assets and financial assets. And again, we're looking for these longer term relationships, these promises of future payments. So when we jump forward, I actually really like the way the United States lists these in their balance of payments, right? Notice US owned assets abroad, not counting financial derivatives, right? But US owned assets abroad. So these are things now owned by Americans that exist in other countries. And notice that that is a negative. The United States is, or the United States citizen is receiving the asset, a stock or a physical property, but to do that we have to send money to another country. Because we have to send money to another country, this goes negative. But foreign owned assets in the United States, right, inflow of dollars, money comes into the United States, but we have to give up a financial asset, or we have to give up a physical asset to someone in another country, right? Someone in China now owns something in the United States, perhaps stock in Microsoft. They send money to the United States, but they receive an American asset. So to summarize one more time, the balance of payments is applying and sorting financial transactions. And on the current account, we have goods and services, net exports. We have the idea of the trade deficit or the trade surplus. And on the capital account, we have asset transfers. We have capital inflow and outflow, that term we've used before, and that's going to become really important in our next little lesson in a few days. And these are ways of saving money. So the current account is pretty much about spending in foreign countries, and the capital account is about a way of saving or investing in foreign economies. Right? And we're measuring how and where the currency moves. We care about the dollars. Of course, we certainly care about the asset itself or the good itself, but the balance of payment actually only tracks where the dollars physically go. So when dollars leave the United States, then one of our two accounts goes negative, but when dollars come into the United States, our accounts go positive. The last thing I always like to add to this discussion is simply a really quick discussion of why these accounts have to add up to zero. This is something that is not immediately obvious to a lot of students. I don't think it's always explained well in textbooks. So I'm going to give it a quick go as to why these have to add up to zero, or why when the current account is positive, the financial account has to be negative. But aside from that, you will never have to explain this for our purposes, but you should always know it. It should always be in the back of your mind, and you'll see that in some of our future problems, that this relationship becomes very important, just memorizing this relationship. So here goes. Why, when the current account is positive, does the financial account have to be negative? And I'm going to give you guys just a really quick kind of example or case study, in a sense, on this. So let's assume that an American buys a $100 pair of shoes from Germany. In that case, we can say that the American has imported a good worth $100. But that means the American has also sent $100 out of the United States and sent $100 to Germany. So the logical question is, where does that transaction show up? And that transaction, hopefully you should be able to follow along and see that that transaction shows up as the US current account going negative. The American sends $100 to Germany, the current account goes negative, and we receive the shoes in return on the current account as well, but the current account tracks only the movement of the dollars. But this leads to a kind of an obvious question. What is a German citizen in Germany going to do with $100 American dollars? And the first thing to know here is that countries generally only accept their own currency. You couldn't walk into an American business and pay with Canadian dollars or pay with Japanese yen. or pay with euros. So a German citizen probably isn't going to be able to walk to his local grocery store and pay with American dollars. They would use euros instead. So there's kind of a very simple choice that this German citizen has. The first thing he could do is he could buy $100 in goods back from the United States. But if he buys $100 in goods from the United States, then that's an export for the United States, and that would end the trade deficit. He would send the $100 back in return for goods. The current account, which had been negative, will now return back with a positive, negative 100 plus 100. The current account is back to zero. Or he could use $100 to buy an asset from the United States. He could use the $100 to buy a stock or a bond. He could save his $100 in the United States. And in that case, the capital account for the United States becomes positive. So negative 100 on our current account links to positive 100 on our capital account. And that really is the balance here. There's an element of circular flow. American dollars are only good in America, so they have to come back to America. So if we send dollars away on either account, they have to come back. And if they come back on the same account, then we're in balance. Or if they come back on the opposite account, then we're also in balance, but the two accounts are now opposing each other. And if you're sitting here thinking, well, couldn't this German guy just exchange this money? The answer is, of course, yes, he could exchange it, but you have to follow that up with another question. Who's he going to exchange it with? He's going to need to find somebody in Germany who needs 100 American dollars. And the only reason somebody in Germany needs 100 American dollars would be to buy an American asset or to buy an American good, which all will come back on the current account. So the only way that money moves across borders is for the purchase of goods and services and assets, and that money always kind of has to return home. And this is going to play a big role in a couple days when we talk about whether we should care about the trade deficit in the United States. But think about it, when we always talk about China, and the United States has a massive trade deficit with China, upwards of $500 billion a year that we send to China for goods that they do not send back, that sentence is always actually incomplete. We send $500 more billion to China than they send to us for goods. But that $500 billion still has to come back. And it has to come back, and it comes back in the form of Chinese investment in the United States. They lend it to our government to cover the national debt, and they lend it to our businesses when they buy stocks and corporate bonds and other assets that make them wealthier and provide a form of savings for them. So the balance of payments always has to be balanced. It always has to be equal, because dollars always have to return to their home. So that's our summary. This should help you complete the practice problems, just sorting whether goods and services are on the capital or current account. We'll also record a solution page to that and see how you guys do. But this is step number one. You've got to know what belongs on each account.